Get ready for some exhilarating financial insights because, according to Wells Fargo, we're on the cusp of a recession. However, investors seem to be under the spell of a Goldilocks scenario. Unfortunately, things may not end well. We will also delve into the captivating topic of artificial intelligence and how we can capitalize on this market. Brace yourself, as Wall Street's repeated warnings about a recession are losing their edge. Despite a year of doomsday predictions, the U.S. economy has displayed impressive resilience. Stubborn inflation hasn't dampened spirits, with unemployment rates staying near pre-pandemic lows and consistent GDP growth. Even the stock market has bounced back after a lackluster 2022, surging by a whopping 16% year-to-date as the S&P demonstrates its strength. However, don't be fooled. Darryl Cronk, the president of Wells Fargo Investment Institute, asserts that the evidence overwhelmingly points to a recession looming on our doorstep. Cronk, speaking at a mid-year outlook presentation, highlights that the manufacturing sector is already in recessionary territory, supported by the ISM Manufacturing Index, which revealed a seventh consecutive month of contraction in May. Additionally, leading economic indicators have persistently declined for over a year, reaching levels consistent with past recessionary cycles. The Conference Board's Leading Economic Indicator Index, which assesses factors such as building permits, average weekly hours worked, and manufacturers' new orders, exhibited a downward trend for 13 consecutive months through April. While acknowledging the labor market's stability and the relatively strong services sector due to consumer savings built during the pandemic, Cronk still foresees the worst yet to come for the economy. Samana, Wells Fargo Institute's senior equity strategist, adds to the excitement by stating that investors are overlooking the gloomy economic outlook while getting caught up in the latest advancements in artificial intelligence and diminishing inflation. It's a real dichotomy, and Samana warns that this optimistic market scenario may not have a happy ending. Inflation remains above the Federal Reserve's 2% target, with Fed Chair Jerome Powell issuing warnings of further interest rate hikes this year. Corporate profits have been on the decline since the second quarter of 2022. Despite these warning signs, investors are still willing to pay a premium for stocks, with valuations far exceeding historical norms throughout the year. Samana believes this could be a mistake given the ongoing earnings recession. He notes that corporate revenues have been decreasing for several quarters, as some parts of the economy are already in recession. Furthermore, a stronger than expected labor market has led to sticky costs for many companies. In other words, margins are deteriorating, with the top line declining faster than labor costs. As the recession approaches later this year, slowing corporate revenue growth and higher labor costs are expected to impact earnings negatively. Samana predicts that the S&P 500 will drop approximately 7% from its current level of 4,100. Despite these cautionary words, many investors have become increasingly bullish lately. Year-over-year inflation has dropped from its peak of 9.1% in June 2022 to a more manageable 4% in May, fostering consumer optimism. The University of Michigan's Consumer Sentiment Index is on the rise, reaching its highest level since February. Additionally, long-term inflation expectations have slightly decreased, which is good news for economists concerned about entrenched inflation expectations keeping prices high. But what would a recession mean for artificial intelligence, which is supporting the market right now? Analysts believe that artificial intelligence presents an extraordinary $800 billion opportunity for tech firms alone throughout this decade. Dan Ives from Wedbush likens this AI surge to the start of the dotcom bubble in 1995. Tom Lee, the co-founder of Fundstrat Global Advisors and known as the biggest bull on Wall Street, suggests that the economy is transitioning into an expansion rather than a recession, fueled by fading inflation and the Federal Reserve ending its interest rate hikes. However, Samana remains cautious, questioning whether the risk is worth the reward. Despite a recent earnings contraction, the S&P 500 is currently trading at 20 times its peak earnings from last year. In an environment of high volatility, higher inflation, and elevated interest rates, where the Fed may or may not be finished with interest rate hikes, uncertainty prevails. Samana advises against paying high earnings multiples in such an environment and doesn't anticipate an overwhelming upside. In the end, I personally do not think we will enter into a recession because it seems the economy is making a huge comeback. I also do not think artificial intelligence stocks are in a bubble, however, a healthy pullback could be imminent. I hope you enjoyed this stock market news update, and if you made it all the way until now, please like the video and subscribe for more analysis just like this one. With that being said, I wish you the best of luck on your investments.